The broadcast is now starting. All attendees are in listen-only mode.
Good morning and welcome to today's webinar on the 501R regulations. My name is Katie Tarr. I work for a company called LBMC in Brentwood, Tennessee in healthcare evaluation. And today I'm going to give you a brief introduction to our speakers and talk about some upcoming HFMA events and point out just some functionality of today's webinar. First off, you can ask any questions either in the questions section or in the chat box. Also in today's chat box is the link to download the slide deck if you would like to go through that yourself or save that. And I'll be kind of fielding any technical questions throughout the session. If you have trouble hearing or anything is not working with GoToWebinar. And then also if you have any questions for our speakers, I'll be holding those to the end and we'll go over questions at the end of the presentation. We will also have polling questions today, and to receive CPE credit, you need to answer at least 3 of our 4 polling questions. If you have any issues with answering the polling questions, just let me know and I'll mark you as answered if there were issues. I usually allow about a couple minutes to answer, and again, there's no points taken off for a wrong answer, so please just answer in the time required to receive that CPE credit. And upcoming events for HFMA, just to go over briefly, our next webinar will be called The Financial Impact of Readmissions. That will be held on June 9th, and it will be presented by Jim Hoffman, the COO of Bessler Consulting. You can visit tnhfma.org/webinars for more information. Secondly, our annual Spring Institute is coming up this month here in next week, starting on Monday, May 18th and going through the 20th. Registration is still open and it will be held at the Embassy Suites in Cool Springs here in Nashville, Tennessee. You can find more information and register at thespringinstitute.org. You can also go to the HFMA website, and there's a link from the homepage. We have a great lineup of speakers. On Monday, Bernie Sherry, the CEO of St. Thomas West in Midtown, will be speaking. We'll also have a CFO panel and a revenue cycle panel with local and state healthcare leaders. It'll be a great time. And again, if you want to register or learn more, such as view an agenda, you can visit thespringinstitute.org or go to the TN-HFMA homepage and click the link from the homepage. Lastly, we have finalized our dates for the Fall Institute, which will be held October 21st through the 23rd in Gatlinburg, Tennessee. So please save the date for that. And just a last reminder for those of you that have just joined, to obtain CPE, you have to be connected to the webinar for at least 90% of the duration of the length of the webinar, which will be an hour, and you need to respond to at least 3 of today's 4 polling questions. Now I would like to introduce our speakers. Brian Todd is a tax specialist in BKD National Healthcare Group and serves on the executive committee of the Branson, Joplin, and Springfield Nursing Facilities and other healthcare services industry team. He has more than 14 years of experience providing tax services to both for-profit and not-for-profit healthcare organizations. Recently, he has focused on helping not-for-profit organizations comply with the new Section 501R requirements, including conducting and reviewing community health needs assessments. Kim has more than 20 years of experience serving tax-exempt organizations. She has spent most of her career providing consulting and compliance services related to the many tax areas affecting hospitals and health systems. Prior to joining BKD, Kim was the tax director for a large hospital and healthcare system. She has extensive experience working with health systems throughout the United States and has assisted clients with tax issues in areas including community benefit reporting, unrelated business income, and compliance with 501R of the Internal Revenue Code. Kim leads BKD's Community Health Needs Assessment practice and has co-developed the firm's task risk assessment process for hospitals and health systems. So please join me in welcoming both Brian and Kim as they lead our webinar today. Thank you very much, Brian and Kim.
Okay, thanks, Katie, and thanks for everyone for joining us today for our discussion on the final 501R regulations. And we've had a little over 4 months now to digest the final regulations and have detailed discussions with our clients and with hospitals. So hopefully we can share a lot of what we've learned in those 4 months with you here today. So our objectives really are first to just cover the essential elements of a compliant financial assistance policy under 501R, and there were a couple of requirements added from the proposed regulations to the final regulations. We'll talk about your options for computing amounts generally billed, and again, there were a couple of additional options added in the final regulations that may give you a little bit more flexibility. We'll talk about reasonable efforts that are required before initiating extraordinary collections actions, and then finally, as we go through each of these sections, we'll try to point out where changes were made from the proposed regulations to the final regulations. So before we start, really just run through some recent background pretty quickly. And it'd be difficult to have a conversation about tax issues for tax-exempt hospitals without mentioning Senator Grassley. I think he really was a driver behind the IRS exempt organization hospital study that was conducted back in the mid to late 2000s, which probably led to a lot of the questions on Schedule H and the redesigned Form 990. And in 2010, obviously, we had the Affordable Care Act, in which that's what added Code Section 501R. And part of that I mentioned that would mention that's not on the slide is as part of the Affordable Care Act, Congress mandated to the IRS that they look at the Schedule H of every hospital 1 year out of every 3 years. And so we call these stealth reviews because the hospitals never know when this is being conducted. It's not an audit. It's really just a fact-finding mission. And so apparently those reviews have been completed, and the IRS has actually made their report to Congress. We're just awaiting to hear what the results of those findings were. So hopefully we'll stay tuned and have information on that in the near future. There's a number of notices and proposed regulations that are listed on the slide that we've been working with over the past several years, and then finally we received the final regulations here right before the end of 2014. So the final regulations under 501R, really in 501R there's 4 primary requirements. The 501R3 requirements are the community health needs assessment requirements, and we're not going to cover those today. I think that requirement is unique enough that we kind of look at it almost as a separate requirement and present on that topic differently. If you're interested in learning more, we do have some archived webinars that Kim presented on the community health needs assessment on bkd.com if you're interested in viewing those. What we'll cover today, though, are the requirements under 501R4, which is the written financial assistance policy requirements, limitations on charges and amounts generally billed under 501R5, and then finally under 501R6, the requirements to make reasonable efforts before initiating extraordinary collections actions. I didn't list 501R1 and R2. Those are obviously part of the code as well. The regulations under R1 contain a pretty nice glossary of terms that are used throughout the 501R regulations, and then 501R2 is important because it provides guidance on the consequences for failing to meet these requirements, and then also it provides information on how to correct some of those failures if you have issues. Now hopefully we'll go through all the rules and regulations and you won't have to worry about failures, but if you do need that guidance, it is there in 501R2. Before we get into some of the details, just kind of some quick overall thoughts and recommendations on 501R compliance. This is going to be a project for hospitals that is definitely going to be a team effort. So I think every hospital needs to identify who's going to be a part of that team and develop a timeline for implementation. There are going to be changes that require board level or committee level approval, And so getting on those calendars and making sure you have the policies and procedures in place in time to meet for those meetings is important. With anything like this, I think a gap analysis can be beneficial to take your current policies and procedures and put them up against the final regulations just to determine what needs to be adjusted. But probably equally important is not to stop with initial assessment, but also to try to develop tools and processes internally where you can monitor on an ongoing basis compliance with these regulations. You know, with any time you change policies and procedures, you could also have state law considerations and reimbursement considerations. So, you know, that's part of where the team approach comes in. You probably will have legal counsel involved. You'll probably have reimbursement professionals, tax professionals, a number of people involved in making sure that you get your policies and procedures in compliance. I would say that many of the changes from the proposed regulations would be considered hospital friendly. I think there's one in particular we'll talk about that kind of popped up in the final regulations that the IRS has gotten some backlash on. I'll talk about that in a little bit more detail, but the majority of the changes I think are hospital friendly. And if you wanted to read an analysis of some of the suggested changes and why they made those changes or why they chose not to make changes, the preamble to the final regulations it's a pretty good read if you're interested in knowing why some of the changes were made or why some were not. And then the last thought is just that, you know, I really haven't talked to a hospital yet that I didn't think would have to make some changes to policies and procedures. I think even if you fully adopted the proposed regulations, it's likely you'd still have some minor revisions to make to comply with the final regulations with the changes that were made between the two. The first question that I usually get with respect to the final 501R regulations is just, when do we need to be in full compliance with the final regulations? And they always write these timelines a little bit, make them a little bit confusing, but you have to be in compliance by the beginning of the first tax year beginning after December 29th of 2015. So the first hospitals impacted would be calendar year-end hospitals that would have to be in compliance by January 1st of 16. So if you are a June 30 year-end, you have until July 1 of 16. If you're September 30, you'd have until October 1 of 16. So you have some time. Until then, you're just required to make a reasonable interpretation of the guidance that existed prior to the final regulations. And the second question, really, determining when you must be in full compliance, is really, you know, just in a little more detail, who must comply. And generally, the IRS defines hospital organizations as an organization that operates one or more hospital facilities, and that's defined by state law if you're required to be licensed in your state as a hospital. One of the clarifications that they made in the final regulations is that multiple buildings operated under a single license are considered a single facility, and the clarification really there in the proposed regulations, it said that they may be considered a single facility. So they kind of took out any potential confusion. So if you do business in a large metropolitan area and you have a north campus and a south campus, and but you're under one state license, for 501R compliance purposes, that's considered one facility. Continuing on with that, dual status hospitals have been discussed frequently throughout the process of the issuance of these regulations, and dual status hospitals do have to comply with 501R. So these are hospitals that are governmental hospitals that also have 501c3 status. One important thing to note, though, is that in the final regulations, they do make it clear that dual status hospitals may voluntarily terminate C3 status if they feel that they no longer need it. So typically the dual status hospitals sought 501c3 status so that they could offer a 403B plan, or they may have relied on their C3 status for tax-exempt bonds, But if you don't need that C3 status and you voluntarily terminate it, then you would not have to comply with the 501R requirements, including the community health needs assessment requirements. The applicability to hospital-owned entities depends on the federal tax classification of that entity. A wholly owned or partially owned corporation does not have to comply with 501R, so this could be a taxable entity or a tax-exempt entity. So if you have a subsidiary physician corporation, it would not have to comply with 501R. A disregarded entity, so this is like a single member LLC that's providing services in the hospital facility, would have to comply. And a partnership can depend, and we'll talk about that a little bit more in a couple of slides, but in the final regulations, they added a new term of a substantially related entity, which could apply to partnerships. So that leads us to our first polling question.
Yes. Our first polling question is, what step is your hospital on in evaluating compliance with the final 501R regulations? Please select one of the following: haven't started yet, formed our compliance team, almost done, finished, or unsure. And again, to receive CPE credit for today's webinar, please be sure to answer 3 of the 4 polling questions. I will leave the question open for a few more seconds. It looks like most of our attendees have answered unsure or formed our compliance team. About 46 saying unsure and 22 saying formed our compliance team.
All right, thanks, Katie. That's kind of what we expected and what we've seen in the last couple of webinars that we've done. And so with that, we'll move in to the details of the regulations under Section 501R4, and these are the financial assistance policy requirements. And so the first slide, you can see the bubbles contain many of the required elements of a financial assistance policy under the final regulations. And some of these we'll discuss in a little bit more detail in subsequent slides. But really the first requirement here of the financial assistance policy, and I don't think would be an issue for many hospitals, but it has to be a written policy, which I think most hospitals have had a written policy for a number of years. But it also must be adopted, as I mentioned before, by an authorized body of the hospital, which typically would be the board of directors, but if state law would permit that authority to be delegated to a committee of the board, then you might be able to have that approved by a committee of the board also. The policy must also specify eligibility criteria and the basis for amounts for calculating the amounts that you charge financial assistance eligible patients. And so you must specify all the financial assistance available and the amounts to which discount percentages are applied. So in this case, I always thought that examples are helpful to demonstrate this particular requirement. You must also list or provide information on the method you use to calculate amounts generally billed. And if you use the Lookback method, you also must provide details of that computation. And Kim will discuss the amounts generally billed requirement in more detail and get into the Lookback method a little bit. And finally, for this particular requirement, you also must have a statement in your policy that says that an eligible patient will not be charged more than amounts generally billed, which that was also one of the requirements specified in the proposed regulations. One of the new requirements is to list other sources that you may use to make a financial assistance determination, and this is really getting to presumptive measures. So if you're using some other method other than the financial assistance application that a patient would be completing to make that determination, that needs to be spelled out in your policy. And we'll talk about presumptive measures a couple more times throughout the presentation and talk about that in a little bit more detail. still have the requirement for policy relating to emergency medical care. Really nothing new to report there. You must also provide information on the method for applying, so the information like what is required of the patient to provide, and contact information on individuals or a department that they can contact if they have questions about completing the application. The next requirements is another new one and this is really the one that I mentioned has received some backlash, and we'll talk about it a little more detail, but a list of all outside providers delivering emergency or medically necessary care in the hospital facility. And then finally, if you don't have a separate billing and collections policy, you must include actions that may be taken in the event of non-payment. So these would be like extraordinary collections actions and the processes and time frames for taking those actions, and then who has the authority at your facility to determine when you've made reasonable efforts before initiating these actions. And then if you do have a separate billing and collections policy, then your financial assistance policy should just contain a reference or a link to where people can obtain that information. So continuing on with the financial assistance policy, it must apply to all emergency and other medically necessary care, and this is where the term of substantially related entity comes into play, that it must also include care provided by a substantially related entity. And that would be a partnership for federal tax purposes in which the hospital owns a capital or profits interest, and or disregarded entities such as a single member LLC that are providing emergency or other medically necessary care in the hospital facility. So it'd only be an example would be if you're a member of a joint venture and you have physicians that own half of the joint venture and the hospital owns half of the joint venture. If those physicians are providing services in the hospital, then they would need to be compliant and covered under 501R and the financial assistance policy. The exception is if you're invested in one of these joint ventures and you treat for tax purposes, you treat the income that flows through to the hospital as unrelated business income, then that entity would not need to comply with 501R. So let's say your joint venture, the hospital only owns 25% of it, so it doesn't have the control required to consider that exempt function income. You pick it up as unrelated, then that entity would not have to comply with 501R. On the medically necessary piece of this, the IRS has given us some flexibility on defining medically necessary care. They say that you can define it under state law, the Medicaid definition, generally accepted standards of medicine, or even an examining physician's determination. So you have some flexibility there to define in your policy what medically necessary care is. Now, one of the new requirements that I previously mentioned was to list providers, and I clarify on the slide, providers other than the hospital facility itself delivering emergency or medically necessary care are supposed to now be listed in your financial assistance policy, and your policy should specify whether or not those providers are covered under the FAP. So there's no requirement that they are covered, but you just have to be specific in your policy. In the regulations, they do, caveat though that if you outsource services to third parties for your emergency room, and they are not covered under the FAP, that may not be considered to operate an emergency room for community benefit standards. So that could be, a potential issue that you want to avoid. I will say that, there's been some recent talk on the backlash that the IRS has received on this particular requirement, that really came out of nowhere, that it wasn't included in the proposed regulations and was added to the final regulations without the ability for the public to make any comments. So there is a chance that this particular provision could be modified or even removed from the final 501R regulations. So you'll want to monitor this particular requirement as we move forward. For explaining the basis for amounts charged to patients. I mentioned this a little bit previously, but the IRS did in the final regulations acknowledge and address situations where you may offer discounts outside of your financial assistance policy. So it could be an uninsured discount or a prompt pay discount, and the IRS has indicated that these discounts do not have to comply with 501R. So you could offer an uninsured discount for IRS purposes, whatever level you want. I think there are some Tennessee limits for what an uninsured patient may be charged, so that there may be an area where you've got some disconnect with state law versus 501R. So you want to make sure you address both those issues. But in the regulations, the IRS does specify that these uninsured discounts or prompt pay discounts, do not count as community benefit for Schedule H reporting purposes or, evaluating hospitals' exempt status. And so, I think one area here where we had a lot of discussions with hospitals is really clarifying how, if you offer these discounts and you also offer financial assistance discounts, being clear on how those discounts, say, interact with each other. So if you offer an uninsured discount and then someone also qualifies for financial assistance, are those two policies mutually exclusive, or does the uninsured discount apply first and then you apply the financial assistance discount? So, for example, if you had a $1,000 charge and a patient automatically got a 30% uninsured discount, which would get it down to $700, and then they get a 50% financial assistance discount to get another $350 off, and they would then pay $350. Well, really there you've got $300 of a contractual allowance, and you've got $350 of a charity care. Well, if you were to make those policies, mutually exclusive, so they can't qualify for both, but then you just offered a more generous charity care discount. So say you offered them a 65% charity care discount, but they didn't get the uninsured discount, they would still pay $350, except now you have $650 of charity care rather than splitting it between contractual and charity care. So things like that I think can be important, and for reimbursement purposes. Also, if you had future revenue that was contingent upon how much charity care you're providing, that could also have an impact on that particular incentive. So as far as specifying the methods for applying for financial assistance, like I said, the IRS did recognize that you could make presumptive determinations, and Kim will talk about this in a little more detail. And they also said that you can obtain information orally from the applicant, but you're not required to accept it orally, but you may. It's still a requirement to widely publicize the financial assistance policy. So that would include your financial assistance policy, the application form, and a plain language summary. I haven't really talked much about the plain language summary yet, but in a couple slides I think I'll have the elements that will be required in this, what they refer to as a plain language summary, where it's really a lot of the elements of the policy itself, but just more in a summary format. You have to make paper copies available upon request, and at a minimum in the emergency room and at admissions areas. You must have conspicuous displays, reasonably calculated to attract attention around the facility. And then probably the most challenging requirement is to notify residents of your community in a manner reasonably calculated to reach those who are most likely to require assistance. And the whole notion of reasonably calculated is one of those things in IRS regulations that goes back to facts and circumstances. So really no great definition of what reasonably calculated is. It really just comes down to facts and circumstances. Continuing on with widely publicizing the financial assistance policy, the one thing that the final regulations did was eliminate the requirement to list the measures that you are going to take to publicize the policy. So now you only have to initiate the measures rather than go through and list all of them in your policy. So that should cut down on the length of your policy a little bit. Some of the notification requirements that were initially in the 501R6 regulations or the proposed regulations were moved, and some of the burden, I think this is really where some of the more positive changes came about, where the proposed regulations would have had you attaching, multiple times their plain language summary of your policy to billing statements, and that's pretty much been eliminated. That now your billing statement just has to include a conspicuous written notice that notifies the recipient of your FAP and includes contact information for them to obtain that or ask questions. One other clarification is that the plain language summary is just required to be offered as part of the intake or discharge process, and so if someone knew that they weren't going to qualify for assistance and declined taking a copy of that plain language summary, you wouldn't be in any violation of any rules at that point. So the next slide, it lists the required elements of your plain language summary. I'm not going to go through all those, but you can go back and review those, but really just summary information from the financial assistance policy itself. There's also a requirement if you have limited English proficiency populations in your community to potentially have translations of your documents that include for language groups that constitute either 1,000 individuals or 5% of the population, whichever is less, and you can use any reasonable method to determine the LEP population, so whether it's Census Bureau data or even your own experience with LEP populations. And they changed the proposed regulations had a 10% threshold, but they changed this to be more consistent with HHS guidelines. I mentioned as far as establishing the financial assistance policy and the related policies, I mentioned before the approval by authorized body. This also includes your billing and collections policy and your emergency medical care policy. So just, you may want to go back and make sure that these policies have been approved by an authorized body. One question that I get a lot is for systems with multiple hospitals, can we have identical financial assistance policies? And the answer is almost. You can have pretty much identical policies, but each facility will likely have to have its own amounts generally billed computation and percentages built into the policy. So as long as you identify those in a joint policy and clearly identify the facilities that the policy applies to, you'd be in compliance with that particular requirement. So just kind of some closing thoughts on 501R4. The first thing obviously is to gather these policies and then perform a gap analysis. And I think most hospitals, if you hadn't done it as part of the proposed regulations, would need to draft their plain language summary. If you're outsourcing, you need to start taking inventory of those outside providers that provide services in your facilities. And with the uncertainty whether you go ahead and implement that into your policy or whether you just kind of take a wait and see approach, you probably still need to start the process. If you use presumptive measures, you need to evaluate whether these are described adequately in your financial assistance policy. If you're offering the uninsured discounts, like we talked about before, kind of evaluating how the uninsured discount interacts with your financial assistance discount is important. And the final point is just, and I know Tennessee is a state like Missouri that has not expanded Medicaid yet, but in the states that have expanded Medicaid, I think, you'll see a shift from charity care to Medicaid shortfall when you look at the Schedule H and on the 990. And then, also as we see more high deductible plans for the hospitals that don't provide or don't allow patients with insurance to qualify for financial assistance, you could see an increase in bad debt and a reduction in charity care. So I think a lot of hospitals are evaluating whether to extend some type of financial assistance to those particular patients if they feel like they're not going to be able to collect the money regardless, or they're spending way too much time and effort chasing those bad debts, that may be a way to cut that down and keep your charity care from dropping, and while your bad debt rises. And so if you're not going to get paid for the service, you'd rather have the cost captured in charity care rather than bad debt generally. So
Brian, can I interrupt for just a second?
Yeah, go right ahead.
We had a couple questions. On slide, I think 20, there was a percentage listed, and we had a question whether that was down from 10%.
Yes, that was down from 10%.
And then we had a second question asking if there is any guidance on listing outside providers.
Well, I mean, it's just that, there's no specific guidance, but I think it would be, if you've outsourced to, if you've got independent contractor physicians, or you're contracting with a radiology group or a group to come in and provide services in the hospital facility. The key is that they're providing services in the hospital facility and they're not, employed by the hospital. I don't think that the guidance gets a lot more specific than that, but like I said, there's been quite a bit of backlash on that particular provision because of the number of independent contractors or outside providers that some hospitals have, and how difficult that's going to be to maintain on an ongoing basis because the list always changes. So I wouldn't be surprised if that provision changes quite a bit.
I agree.
That's helpful. The person asked a follow-up question that regarding the interpretation of the detail for the provider. I think you just mentioned it's difficult to maintain that list. Is it required first and last name or name of the practice, etc.?
Yeah, the regulations, they don't go into that much detail. I would kind of,
Brian, this is Kim. I think the regulations refer to it's in situations where patients are going to get bills from multiple providers. So to me, it seems like whatever that individual would be, if it's going to be billing under an entity such as an anesthesia group or something like that, to me, I would probably lean towards having the list of who's going to be sending the bill.
Right.
Okay, I think that answers all our questions so far.
Okay, now I think that takes you to the next polling question.
All right, and our next polling question is, does your hospital have a separate billing and collection policy? Yes, no, or unsure? Again, to receive CPE credit today, you have to remain connected for 90% of the duration of the webinar and answer 3 of our 4 polling questions today. This is the second polling question of 4 polling questions. I will leave the question open for a few more seconds. And again, there's no penalty for a wrong answer. All right, I'm going to go ahead and close the poll. And 68% said yes, 28% said unsure.
Okay, great. Thanks, Katie. And Brian. Brian did a great job going over the 501(r)(4) regulations. Thank you for joining us this morning again, and I'm going to go ahead and walk us through the R5 and R6 regulations. So we'll begin with 501(r)(5), limitation on charges. First of all, under 501(r), we have to limit our charges, and the final regulations provide that a hospital organization meets the requirements of Section 501(r)(5) with respect to a hospital it operates only if the hospital limits the amounts charged for any emergency or other medically necessary care it provides to a FAP-eligible individual to not more than amounts generally billed. One of the things we saw in the proposed regulations is that there was a requirement to limit gross charges to FAP-eligible individuals for other medical care as well. Effectively, the 2012 proposed regulations applied the AGB percentage limitation only to charges to FAP-eligible individuals for emergency and other medically necessary care. And then there was a prohibition on charging FAP-eligible individuals gross charges for any other medical care. So there were a few commenters who interpreted this language to mean that the prohibition on gross charges even applied to elective procedures not covered under the FAP. The one thing the final regulations did clarify was that this limitation on gross charges only applies for care covered under a hospital's financial assistance policy. So essentially, a hospital's financial assistance policy may include, but is not required to cover care other than emergency and medically necessary care. So on this item, as far as gross charges for all medical care, you do have to make sure that the limitation is applied to care covered under if it's a FAP-eligible individual, but only for care identified in the hospital's financial assistance policy. So, and that is one thing I am seeing as hospitals, as they are reworking or making the modifications to their financial assistance policies, they're adding a lot more clarification and detail regarding what types of services will and will not be covered. The final regulations also gave us a better definition of the term medically necessary care, as Brian said. For purposes of the financial assistance policy and the amounts generally billed limitations, in recognition of the fact that healthcare providers and health insurers may have reasonable differences in opinion on whether some healthcare services are medically necessary in particular circumstances. So in defining medically necessary care for purposes of their financial assistance policies and AGB limitations, the final regulations clarify that hospitals may, but are not required to, use the Medicaid definition used in the hospital state, other definitions provided by state law, or they might use a definition that refers to generally accepted standards of medicine in the community, or they can use an examining physician's determination. The final regulations still have two methods for determining amounts generally billed. We have both the Lookback Method and the Prospective Method. However, within the final regulations, the way these are calculated have been expanded to also include Medicaid, and I'll get into more of the actual calculation and what that means on later slides. The final regulations provide that a hospital may change the method it uses to determine amounts generally billed at any time. If you remember, the proposed regulations indicated once you selected a method, you were stuck with that method. In other words, there was no ability to change over time. However, because the final regulations under Section 501R4, which Brian discussed, require the hospital's FAP to describe a new method for calculating AGB before implementing that new method. So one thing to be cognizant of is if you do make changes to how you calculate amount generally billed, or if you change your methods over time, you'll need to be sure that, to regularly, to update the financial assistance policy before those changes are implemented. There were many commenters who stated that allowing hospitals only two methods for calculating AGB was not flexible enough. So the final regulations also recognize that payment systems will likely evolve over time. They allow the IRS and Treasury to provide for additional methods to determine AGB in the future, and they allow the IRS to publish additional guidance as circumstances warrant. One of the things the final regulations did for us was talk about AGB for patients that qualify for FAP eligibility when they have insurance. The final regulations continue to apply the amounts generally billed limitation to all individuals eligible for assistance under the hospital's FAP, without specific reference to the individual's insurance status. Remember that that's something that the hospital can choose whether or not to include in their, as eligible patients, whether or not they have insurance. So One thing to take into consideration is that a hospital can set its own criteria for FAP eligibility. For instance, it can include or exclude individuals with insurance. The regulations clarified in the case of a FAP-eligible individual who has health insurance coverage and that qualifies under a hospital's FAP that a hospital will not fail to meet the Section 501R5 requirements because the total amount required to be paid by the FAP-eligible individual plus his or her health insurance together exceeds AGB. The most important thing that you need to keep in mind here is that you need to really watch that part of the payment that the FAP-eligible individual is personally responsible for paying, and that amount whether it be co-payments, co-insurance, or deductibles, cannot exceed the amounts generally billed percentage for care after all reimbursements by the insurer have been paid. However, the total amount can exceed. Under the look-back method, the amounts generally billed percentage must be calculated at least annually. The proposed regulations provided that the AGB percentages must be based on all claims that have been paid in full to the hospital for emergency and other medically necessary care during a 12-month period. There was a lot of confusion and uncertainty relating to what paid in full really means. So to eliminate the confusion and uncertainty, the final regulations have made a change to this, and they provide that when calculating amounts generally billed under the look-back method, a hospital should include in the numerator the full amount of all of the hospital's claims for emergency and other medically necessary care that have been allowed rather than paid by health insurers during the 12-month period. For these purposes, the full amount allowed by a health insurer should include both the amount to be reimbursed by the insurer and the amount, if any, the individual is personally responsible for paying, regardless of whether and when the individual actually pays. When calculating this, whether a claim is used in calculating the AGB percentage depends on whether the claim was allowed by a health insurer during the 12-month period, not whether the care resulting in the claim was providing during the 12-month period. If the amount the health insurer will allow for a claim has not been fully determined as of the last day of the 12-month period used to calculate the AGB percentage, a hospital should exclude the amount of the claim from that calculation, included in the subsequent 12-month period during which the amount allowed is finally determined. So I think that adds a little bit more clarity here and specificity regarding how this calculation and what should be included in the numerator, and I think this will be a little easier for hospitals to gather. In calculating the amounts generally billed, we have this various insurers that we can use to make this calculation. We have the Medicare fee-for-service, which was in the proposed regulations. We can use the Medicare fee-for-service and all private insurers that pay claims to the hospital facility, or we can use Medicaid either alone or in combination with the insurers described above. So as we previously highlighted, hospitals now have the option of using Medicaid as well, either alone or in conjunction with the other insurers in these calculations. Under the look-back method, a hospital may calculate one average AGB percentage for all emergency and other medically necessary care provided by the hospital, or the hospital may have multiple AGB percentages for separate categories of care, such as you could break it out by inpatient, outpatient, you could break it out by different departments or for different service lines or business lines or items of service. However, a hospital, in calculating the multiple AGB percentages, must calculate AGB percentages for all emergency and other medically necessary care it provides. So I think one thing that we're seeing and that you really want to think about, and when we talk to our colleagues who are really focused in the reimbursement area, is I think one thing you want to think about as you go through this is how difficult do you really want to make this? You know, how many AGBs do you really want to have to calculate and monitor and track? And in our experience, we're seeing a lot of hospitals settle on one or two to try to make this as efficient and easy as possible in making these determinations. Another positive change in the regulations was related to the date the AGB percentage needs to be applied. This was another hospital-friendly provision in the final regs, is that in the proposed regulations stated that the hospital facility was required to start applying the AGB percentage 45 days after the end of the 12-month period, but as you've all seen in some of a lot of the comments, that was not really realistic. So now that period has been extended to where the hospital must start applying those percentages 120 days from the end of the 12-month period. The final regulations also provide that a hospital may include in the calculation of its AGB percentages claims for all medical care allowed rather than just the claims allowed for emergency and other medically necessary care. So there again, you have a little bit more broader options, and it may be a little less complicated in doing this calculation. I think Brian did note this, is that the final regulations do not allow for a system-wide. So for health systems, the final regulations do not allow for a system-wide AGB. However, if you're a health system who bills under Medicare and you have one provider number, you could calculate one AGB. The final rules and regulations also clarify that within a system, individual hospitals may choose different methods. So you might have a health system, and one hospital can use the Lookback and one can use the Prospective Method. So some options there. The Prospective Method. In my work, we've not seen many clients at all or prospects choosing to use the Prospective Method. It is another option a hospital may choose, and a hospital facility using the Prospective Method may base AGB on the prospective payments for Medicare or Medicaid or both, provided that if it uses both, its financial assistance policy must describe the circumstances under which it will use Medicare fee-for-service or Medicaid and determine the amounts generally billed. There are safe harbors for certain charges in excess of AGB. So the final regulations state that the hospital will remain in compliance if more than amounts generally billed is charged under these conditions. The charge was not made or requested as a precondition of providing medically necessary care to FAP-eligible individuals. The complete FAP application has not been submitted, or the individual has not otherwise been determined as FAP-eligible, and the FAP application is subsequently submitted and the individual is eligible, then any excess collected is refunded unless the amount is less than $5. What these provisions do is it really allows hospitals to continue to bill under normal procedures for those individuals that take a long time to complete the FAP application. The final regulations provide that the safe harbor does not apply to charges made or requested to be made or requested as a precondition of providing medically necessary care to a FAP-eligible individual. Thus, if a hospital requires an individual to make an upfront payment for medically necessary care that exceeds AGB for the care, and subsequently the individual turns out to be FAP-eligible, the hospital will have failed to meet the requirements of Section 501R. So I think this is something you should, pay close attention to, and if you, as far as requiring the upfront payments, definitely want to make sure you have policies and practices in place to help keep you from not meeting these safe harbors. Some last thoughts on 501R5. What we're seeing now is that many hospitals are really moving away from the sliding scales discounts to really having one or two discount levels and really going straight to, as Brian alluded to, maybe a more generous charity care discount in order to capture most of these write-offs under charity care. It really makes the FAP application a little easier to follow and easier to apply as well. What we found with some of the small discounts could really be problematic as far as if if your AGB was 45% and you gave a 15% discount and that was the only discount and that person was FAP eligible, in theory, you know, at that point you didn't give enough discount to meet the AGB requirement. The most critical aspect to keep in mind here is that the IRS has not mandated what criteria you must be used to determine FAP eligibility. Hospitals can set their own criteria as uninsured. They can include insured or only include all uninsured. It can be based on various poverty levels. As Brian mentioned, with high deductible plans, you can work those into your financial assistance policy, and the IRS has really given, you know, no criteria. Additionally, certain services can specifically be excluded as not being medically necessary. I think the one thing to keep in mind is how much time do you want to spend creating a calculation that creates the highest AGB. You have to weigh the costs and benefits. Based on, you know, really how much revenue you think you may collect. With that, I think we're to our third polling question.
Our third polling question is, which AGB method is your hospital using or planning to use? Lookback Medicare plus private, Lookback Medicare plus Medicaid, Lookback Medicare, Medicaid and private, or prospective. And again, to receive CPE credit for the webinar today, you must answer 3 of our 4 polling questions. This is our third polling question. We will have one more here shortly. And again, you also must remain connected for 90% of the duration of the webinar. I will leave the question open for a few more seconds. Again, no penalty for a wrong answer. I will go ahead and close the polling question. And it looks like the highest percentage, 40%, said Medicare, Medicaid, and private, with the second highest at 27% of Medicare and private, and third highest at 21% at Medicare. So 40% at all 3, and then 20% evenly between Medicare and private.
Okay, great, thanks. All right, we'll move on and finalize 501(r)(6, and I'll start talking a little bit more quickly here. I think we're coming down to the wire. As far as billing and collection, the final regulations provide that a hospital meets the requirements of Section 501(r)(6 only if the hospital does not engage in extraordinary collection actions against the individual to obtain payment for care before making reasonable efforts. The IRS did come through and define several ECAs. They include selling an individual's debt to another party, but there are some exceptions. Reporting adverse information to consumer credit reporting agencies, deferring or denying or requiring payment before providing medically necessary care because of non-payment of previously provided care under the FAP, or actions that require a legal or judicial process. We'll spend just a couple of seconds here talking about, as I said, there were some exceptions to selling an individual's debt to another party. The final regulations retain the general rule that this debt sales are ECAs. However, if certain conditions exist prior to the sale, then the sale of the patient debt is not an ECA. So the purchaser is prohibited from engaging in ECAs. As long as the purchaser is prohibited from charging interest in excess of the rate in effect under Section 6621A2 at the time the debt is sold, the debt must be returnable or recallable by the hospital upon determination by the hospital that the individual is FAP eligible. And if the individual is determined to be FAP eligible and the debt is not returned or recalled by the hospital, the purchaser must follow procedures in an agreement to ensure that the individual does not pay. So basically, because debt sales are subject to these 4 conditions, they're not considered ECAs under the final regulations, and these debt sales can be made prior to first having made reasonable efforts to determine FAP eligibility. However, debt sales that do not satisfy these 4 conditions are ECAs and therefore may not be made until after a hospital has made reasonable efforts to determine FAP eligibility. During the proposed regulations, if you remember, we if you gave presumptive charity, the hospital was required to give the most generous discount under their financial assistance policy. And essentially that's been changed under the final regulations, where if we do have a presumptive determination and the individual can qualify for less than the most generous discount, it will constitute reasonable efforts if 3 conditions are present. And that's if we must notify the individual regarding the basis for determination and the way to apply for more generous care, gives the individual a reasonable amount of time to apply for that care, and accepts a completed application within the application period and determines eligibility. So as long as we really notify the patient that they are possibly could obtain a higher discount if they are willing to complete the application, and we will go ahead and meet the reasonable efforts requirements. The final regulations still have the applicable 120-day notification and 240-day application period, which starts on the date of the first post-discharge billing statement is provided. That's another change. Instead of just having the first billing statement, it's been clarified to be the post-discharge billing statement. A billing statement for care is considered post-discharge if it is provided to an individual after the care is provided and the individual has left the hospital. The final regulations also clarify that a hospital may satisfy the notification requirements simultaneously for multiple episodes of care for purposes of notifying the individual about its FAP and potential ECAs. If a hospital aggregates an individual's outstanding bills for multiple episodes of care, it may not initiate ECAs until 120 days after it provided the first post-discharge bill for the most recent episode of care included in the aggregation. Under the reasonable efforts continued, one of the things that remains in the final regulations is that obtaining a waiver does not constitute reasonable effort. For persons who do not think they'll qualify, before we engage in ECAs, we still need to go through the process of determining if they're FAP eligible or not. The 2012 proposed regulations provided that if a hospital facility refers or sales an individual's debt to another party during the application period, the hospital will have made reasonable efforts only if it obtains legally binding written agreement from the other party to abide by reasonable effort standards. Sorry. So the application period, basically hospitals still need to accept and process the financial assistance application through the application period, which begins on the date the care is provided up until the 240th day after the first post-discharge billing statement. There are some exceptions, and one of the nuances here is that if you had an individual that turns in an incomplete FAP application, you cannot initiate an ECA. Could not initiate an ECA until the 240th day. So that was under the proposed regulations. Now, basically, if you have an individual who turns in an incomplete application, say on day 130, you have to give them reasonable time based on the facts and circumstances to provide the necessary information. You would want to provide them a plain language summary and to direct them on what is still required to obtain assistance. Once these requirements have been met, you may initiate an ECA at that time. It's really now a reasonable standard that's being applied. However, if in the future they subsequently provide a complete application, you will need to suspend collection efforts at that time. Before engaging in an ECA, you must do the following at least 30 days before starting an ECA, and these are similar to the proposed regulations. You need to provide a written notice that financial assistance is available and identify any ECAs that you plan to take and state a deadline no earlier than 30 days after the notice is provided. You need to provide a plain language summary with a written notice, and you need to take a reasonable effort to orally notify the patient that you are going to take collection action if they don't comply with your requests. One of the more, and Brian mentioned it, patient or hospital-friendly changes in the final regulations was that, under the proposed regulations, you needed to provide 3 written notices, attach the FAP policy to 2 billing statements. Now, it's really on your billing statements, you need to make a reference to the where the patient can access FAP information in the FAP application and contact information, and they did loosen these paper requirements significantly. So one last slide here. That if a completed FAP application is received during the application period, a hospital will have made reasonable efforts. If ECAs are suspended, it makes financial assistance determination on that individual. You may need to provide a revised billing statement if they qualify for assistance, and you need to refund any excess payments unless the amount is less than $5, and take all reasonable available measures to reverse any ECAs. So many hospitals have separate billing and collection policies, so we just want to make sure if you do have separate policies to make sure they're appropriately approved. Review your billing statements and make sure there is language regarding financial assistance and as well as contact information. Closely review your contracts with third-party collection agencies and make sure there is language that requires them to abide with the reasonable effort requirements. Review your policies and procedures for writing off bad debts, and review ECAs as you go through this. With that, we have our final polling question.
Our final and last polling question is, does your hospital use presumptive measures to determine financial assistance eligibility? The answers are yes, no, or unsure. And while you all are answering those polling questions, Kim and Brian, I'm going to just bring up a couple questions that have come in during the second half of our presentation. One person did ask, if we don't use any presumptive measures to determine eligibility, do we have to mention that fact in FAP?
No.
Great. Well, we have about 81% of our attendees have voted again to receive CPE credit. You must answer 3 of our 4 polling questions today. So this is our last and 4th. If you've answered all 3, you should be good. I'm going to go ahead and close the poll here in a second. And it looks like we have about 51% reporting unsure and 45% reporting yes. We did have one other question about eligibility, and they stated, can you explain when the limit on charges apply? If it is only for FAP eligible individuals, then is the limit really based on what we can charge for partial charity approvals?
Kim, do you want to take that one, or do you want me to?
Can you read it again one more time?
Sure. Can you explain when the limit on charges apply? If it's only for FAP eligible individuals, is the limit really based on what we can charge for partial charity approvals?
Yes, I think that's what it's getting at. Is if you offer someone a 50% discount, they apply for assistance and they qualify, and you're going to give them a 50% discount. That's only acceptable if your AGB computation says, comes out to be 50% also. So you can't charge them more than someone that has insurance covering the care using the insurers that you chose from the Lookback Method or whichever method you chose.
Okay, and we had another question regarding presumptive measures. Are there any new restrictions on financial background info, credit check, bankruptcy history, propensity to pay, etc.?
I'm not aware of anything like that in the 501R regulations. Are you, Kim?
Yeah, no, the regulations, well, they didn't really say anything, but what they did say was, you could use things such as the, the background checks and other information to make determinations that you didn't, if they didn't complete an application, you can rely on some of these other sources.
Yeah.
But that's I don't know if that's what the person is getting at or not.
Yeah, it's up to you on which sources you use, I guess, as far as the IRS is concerned.
Right.
And there was one last question regarding slide 41. The person states, you indicated the agreements with third parties must ensure that no ECA is initiated until reasonable efforts are made. The question is, does that apply to any and all third parties? And then if by agreement with third party, no ECA will ever be initiated before the 240th day after post-discharge billing statement, is that a safe harbor? So the question was, you indicated agreements with third parties must ensure no ECA is initiated until reasonable efforts are made. And the first question is, does that apply to any and all third parties?
Well, I would think any third parties with initiating collection activities.
And then the second part of that is, if by agreement with third party, no ECA will ever be initiated before the 240th day after post-discharge billing statement, is that a safe harbor?
Yeah, I think that would ensure compliance if the ECA was never contemplated before the 240th day.
Okay, I think that answers all of our questions. And certainly, I believe Brian and Kim's contact information is on the presentation, which you can download through the link in the chat box. And certainly you can follow up with them if you have any additional questions.
Yes, feel free to send Brian or I an email if you have any questions.
And a big thank you to Brian and Kim for their time today presenting this issue to us. And join us for next month's webinar on the 9th of June regarding readmissions. Thanks all.